Good afternoon, everybody. So we'll be doing, can all of you hear me? Is there anybody who can't hear me? Please respond. So hope you all could hear my lecture. Right. Right, okay. Good afternoon, and I'm Mahesh Amarasiri, and I'll be doing evaluation control and 3 topics further. Technology management. Okay, thank you. Technology management, managing small businesses, as well as some case studies. By now, if I take you through the strategic management model, if I were to brief you, we start with environmental scanning, where we gather information about opportunities and the threats. There we do environmental analysis, what is going to happen in the external environment, what is happening in the competitor side, etc. Then we assess our internal scenario, where we assess our strengths and weaknesses in terms of structure, culture, and the resources of the organization, which is known as the environmental scanning. So using these inputs, we subsequently get into strategy formulation stage, where we define our mission, the objectives, what strategies are we pursuing. Then we have the policies, which is known as broader guidelines for decision making, and subsequently we get into the implementation stage. We implement things through programs, which is known as program management. We use budgets for strategy implementation. Then finally, the procedures, so standard operating procedures, where the organization needs to follow in order to get something done. So these are things that are coming under the strategy implementation. Now we are coming to the stage of evaluation and control. In essence, in this stage, what we measure is, so at the strategy formulation session, at that level, we have certain idea. This is the point that we need to achieve. Let's say, for example, we need to achieve $100 million revenue over 3 years period. Now, periodically, you need to measure this particular objective to check whether you are going to reach there or not, which is what is known as, if I mention in very brief terms, what is evaluation and control. We monitor performance against the actual results, and we take corrective action. So in this particular entire session, what we'll be discussing is the evaluation control. So basically, the definition of evaluation control is to ensure that a company is achieving what is set out to accomplish by comparing performance with desired results and taking corrective actions as needed. So as I mentioned to you at the very beginning, it is a periodical measurement that the company usually make to see whether they are in line with their strategies that they have initially agreed upon. Now, organizations do it in multiple forms. Some organization measures their monthly performance against the budget to see whether they are achieved or not. And if there's a variance, they identify what are the reasons for variance and try to correct it as soon as possible. You can get into quarterly level management. You can get into annual level performance measures. Likewise, whatever said and done, what is happening in the evaluation control is you do some kind of evaluation to see whether you are reaching your desired objective or not. In very broad terms, this is what is mentioned by evaluation and control. Most of the organizations, this is happening. Unfortunately, it is happening only for financial performance, because we usually measure our financial performance of the company usually on a monthly basis. You do a comparison against the previous year for the same month. For example, now we just finished our January. So when you have the January month in financials, you compare it against the previous year January, whether we are doing good or bad, and you compare against current year budget versus actuals. You do two kind of measurements. So backward versus the budget. And that is one kind of performance appraisal method. But when it comes to evaluation and control, it should not be limited to financial performance. You should look at many non-financial factors as well. In most of our organization, when it comes to financial performance, we do have a proper evaluation and control mechanism. But unfortunately, when it comes to non-financial things such as customer service, customer satisfaction, brand equity, customer complaints, and etc., there is no formal mechanism for us to evaluate and control. So this is an area that is lagging in most of the organizations, not only in Sri Lanka, worldwide. But when it comes to finance or financial performance, there are very strong control and performance measurement matrices available. So evaluation control involves 5 steps. The first step is to determine what to measure and establish standards of performance, then measure actual performance. Then the fourth step is to compare actual performance with the standard. And finally, you take the corrective actions. So these are the 5 steps involved in evaluation and control. So if you go to this particular diagram, it is shown in a very diagrammatic form. So first step is to determine what to measure. Now, what to determine, what to measure is a very important question. You should be very clear on what to measure. Now, for example, if I give a very basic example, some companies have a profit objective. Some companies have a revenue objective. Some companies have a market share objectives. So you should be really clear what are you going to exactly measure. Are you going to measure revenue? Are you going to measure the profit? Are you going to measure the profitability? Are you going to measure the market share, etc.? So determining what to measure is actually a very broad, very strategic thing to do. For example, certain industries have certain KPIs, what to measure. Now, for example, in the telecom industry, you measure key things such as revenue per user. We call it average revenue per user, ARPU, which is a key performance measure. So basically, those are in different industries, you get different measures that they specifically follow up. For example, when it comes to retail industry, they measure the inventory turnover. Insurance industry, they measure the policy renewal rate. So there are different industries, we have different sets of KPIs, we call it key performance indicators, for them to measure. So determination of what to measure is the first step in evaluation and control. Now, if I give you a non-finance expense, now for example, non-financial example. Now, for example, if you have a small kid, two things what they measure, we want to measure their growth. When you have some small kid, what we want to measure is their growth. So there are 2 ways to measure this according to the medical science. According to the age, you measure their height and you measure their weight. So you have determined what to measure. What you want to measure is the growth of a child. Then you have established what to measure. If you want to assess the growth of a child, you have established 2 things I should be measuring I should be measuring the height, I should be measuring the weight on predetermined intervals. Let's say once a month, once in 3 months, etc., etc. So that is the determination of what to measure. That's the first step. You decided you want to measure the growth. In order to measure the growth, I have decided to measure these 2 variables. I should be measuring the height of the kid or the weight of the kid, sometimes the both. So you have done the first part with. Then the second is establish predetermined standards. Now, let's say somebody comes and tells you the weight of my son or a daughter is 20 kilos. So you determine what to measure, right? And you measure that child's weight and you get an answer of 20 kilos. Let's say you get an answer. Okay, now the problem is you don't know whether this 20 kilos is good or bad. You decided to measure the weight and you took a scale and measure the weight and you got an answer which is 20 kilos. And the problem is now you don't know whether this 20 kilo is good or bad. How do you know whether this 20 kilo is good or bad? In order to do this, you need to know a standard. If there is a standard, then you can compare the actual results against the standard and you can say, okay, you are overweight or underweight. Now, for example, if the standard is 15 kilos and the actual results is 20 kilos, you know, okay, your child is slightly overweight. At the same time, if the standard is 15 and your child's weight is 10 kilos, you can say that particular person is underweight. So we can make conclusions out of it only if we have a standard. So the second step is establish predetermined standards. So when it comes to medical science, again, there are certain standards of, for example, at this particular months of age, a particular child should have this many centimeters of height and this many kilograms of weight. And depending on that particular standard, your actual results may be higher or less. So likewise. So the second step is establish predetermined standard. Now, each industry, each organization has its own standards. Now, for example, inventory turnover days. Let's say if you're in the retail company, let's say the standard of this particular company would be 30 days inventory turnovers. That means your inventory has to be turned out within 30 days. That is 30 days. So that is the standard. But your inventory may be lying in your warehouse for 60 days, which is the actual. So measure the inventory turnover. Standard is 30 days. Actual is 60. That means your inventory management is not at the acceptable level. Similarly for debtors, your credit period to your customers on average is around 45 days. Let's say that is the standard. But your actual could be 40 days. That means, okay, you're doing better than the standard. So that is the standard. So unless and otherwise, we have a predetermined standards, we don't know what is measured is good or bad. Now when it comes to finance, our standard is usually our budget. We compare it against our budget and decide whether we are doing okay with the budget or whether we are doing less than the budget. So one way to establish a predetermined standard is your budget. When it comes to financial management, you have a set budget for the whole year and based on the budget, you determine your actuals are good or bad. Third step is the measuring. Third step is the measuring. So weight and height you can continue to measure on monthly basis. Financial performance, sales performance can be measured on monthly basis. So likewise, the third step is measure the performance. How often do you measure? Now, certain parameters can be measured on daily basis. For example, you can measure your daily sales. Certain parameters can be measured on monthly basis, like profitability, months for the profit. Inventory turnover period can be measured on monthly basis. Customer satisfaction, probably you cannot measure on, it's not practical to measure on monthly basis because the customer satisfaction does not vary on monthly basis. Perhaps you may measure once in 6 months or once a year, likewise. Labor turnover is another something that is measured in the manufacturing industry. How frequently the employees are going out of your organization. So this can be measured on monthly basis. This can be measured on uh, sometimes on once in 6 months, etc., depending on the criticality of the function. Absenteeism is one such measure. Absenteeism can be measured even on daily basis if required, because it's required for your production planning. So in under the measurement of performance, you should exactly decide when to measure, at what frequencies. So that's the third step. This is where your information systems coming into effect, because your information systems should be able to gather all the information that is required for you to measure your performance. Now, in my personal experience, what I have seen is there is a gap between always what your system is capable of giving you as well as what you want to measure. Now, for example, if your systems are unable to give you the performance measures, for example, you want to measure the absenteeism on daily basis, for example, but your systems is unable to provide that information, then no point of having that particular measurement. Either you should change your measurement to sort into your system capabilities, or else you need to change your systems according to your performance measures. But in practice, there is always a gap between performance measurement when it comes to the information systems as well as what the business actually wants. This is where the communication between your information systems as well as your KPIs needs to get streamlined. In most of the businesses, almost all the business that I have associated with, there are a set of KPIs they want to measure, but some of these KPIs cannot be measured by your existing information systems. So that's something that important that we need to keep in mind. Then at the fourth level, you ask this question: does your performance match the standards? Now, for to give you an indication, your inventory turnover days is 60, whereas your standard is 30. Does the performance match with the standards? Answer is no. Then you need to take corrective actions. Then you need to analyze and see why are we exceeding our standard. You do a lot of analysis and do you take corrective actions, and again measure the performance. Again you compare against the actual whether it is until it continues to reach your standard, you take corrective actions and keep on measuring. Now, this technique, evaluation and control, can be applied not only in strategic management but in any field. In medical field also it is happening. Now, if you are suffering from blood pressure, for example, or high blood sugar, what do? You do a periodic test on your sugar levels, or a blood pressure level, or your fat levels, cholesterol. Then check against a certain level of standards. So there are, if you read a laboratory report, you will see blood sugar level for a average male or a female of that particular age should be in the range of, let's say, 200. You measure and you get an answer of 260, which is extremely higher. That means you need to take corrective actions, which means so many corrective actions. You need to do exercising, you need to take medicine sometimes, you need to control your food, you need to control your type of food, and you take corrective action. So doctor prescribes, after seeing your report, what doctor does is, doctor compares your actual results versus the standard and prescribes some correction actions. Prescribe medicine, prescribe exercising, prescribe, let's say, different types of food, etc. And you again ask him to do a test in 3 months' time, again a performance measure, and again compare with the standard. Your blood sugar level, you would have come down by then if the corrective actions are okay. If it is still not okay, again you need to take different set of corrective actions. Again you do a performance measure, another 3 months time, until you reach the standard level of your blood sugar level, then you stop the action and you continue that particular lifestyle. So this is not limited to strategic management. Especially in medical science, this is happening on daily basis. Doctors are doing is kind of performance measurement against the standard, and they know what kind of action needs to be taken if there's something goes wrong with the blood sugar levels, blood pressure, cholesterol, etc. This is a type of performance measures that goes to on daily basis in medical science also. In businesses also, this can be done. Usually this is done against the KPIs that you wanted to achieve versus what you have actually achieved, and you take performance measures appropriately. Now, if you move into this slide, you will see evolution and control, implementation and strategy, figure 11.2. So let me increase the size so that it will be visible. Right. Okay. So when you are measuring, evaluating and implementing strategy, first question that you need to ask is, okay, you are evaluating your implemented strategy. That means you have gone back, you have gone to the previous session, like for example, you measure the performance and you check whether the performance match with the standard, and you get the answer either yes or no. If it is yes, you don't have to do anything. If it is no, you have to take corrective actions. Now what you are trying to do is, this the existing strategy produce desired result. If the answer is yes, the strategy is successfully and the strategy is okay and the results are also okay. So you are perfectly alright. But unfortunately, most of the time you won't get into this level. If you are getting to this level, it's a perfect world. But unfortunately, we don't live in the perfect environment. So most of the time, the existing strategies does not produce desired results. Then the first step that you need to look at is, if the answer is no, obviously, first step you need to look at is, were the strategies poorly executed? The strategy may be good, but the execution may be bad, because by now you would have known strategy formulation is one aspect of that, there's the implementation part of it. And according to research, most of the strategies are getting failed actually at the implementation stage. Strategy is perfect, but is getting failed simply because of poor execution. They need to ask this question, whether strategies were poorly executed or not. Now, for example, inventory turnover days. You have a strategy to bring it down to 30 days, but it is maintaining at 60 days. Does the strategy produce the desired result? The answer is no. Then, were the strategies poorly executed? This is a question that you need to answer. If the answer is again, can be either yes or no. Okay, then you need to ask whether the strategy has been poorly executed or not. Okay, strategy has also been executed okay, according to the guidelines. So somebody has given the guideline to execute the strategy, and you have executed against the according to those guidelines also. So there is no problem in strategy execution. So answer is no. Were the strategies poorly executed? The answer is no. Then you need to ask a question, were the underlying assumptions and the premises valid? For example, you do certain assumptions when you prepare your strategy, because you are doing a kind of a strategy plan, you are thinking ahead, you do all your forecast based on certain assumptions. If the strategy is good, if it is also properly executed, and if you are not getting your answer, probably something wrong with your assumptions then. Then you need to see whether the alternative scenarios has been defined and assessed. So always when you define a strategy, you have a plan A as well as plan B. Perhaps things would have substantially changed when you plan and when you actually executing it. Now, for example, there could have been some unforeseen events, changes of the structure, change of currency. You have estimated the US dollar to be at the same level, but unfortunately it got depreciated during the period. So there are certain things, assumptions that could go wrong. Certain underlying assumptions and the premises has been valid. Then if it is yes, again, then you need to adjust those assumption and prepare a new scenario. Then you need to carry out your strategy execution according to the new scenario. That is what is known as were the current situation and the important trend properly diagnosis. If it is no, then you need to do it again. So we are here now, right? Again, if the assumptions and the premises are not valid, again you have to go here. You need to see whether the strategy formulated adversely affected because of the assumptions now are not practically there. If the answer is yes, invalid planning basis, incorrect strategy formulation. That's your conclusion. Again, your strategy formulation is wrong. You need to go back to your drawing board and come up with a new strategy. So we started here, we started somewhere here. Existing strategy does not produce desired results. It was executed it wasn't executed properly. It was executed properly. Something wrong with your assumptions. Then again you need to go back to your drawing board and you need to plan your strategy accordingly. That is the first step. If your assumptions are okay, wrong, but it does not really impact your strategy adversely, then it could be something wrong with your supporting functions and with the business strategy. So there are functional strategies as well as business strategies. So for example, if we want to bring the inventory control down from 60 days to 30 days, there are multiple departments has to work according to that need. You need to have the manufacturing department, you need to have your technical department, you need to have your IT departments, you need to have your finance departments, working as an entire team in order to bring this target down. So perhaps something to do with your inconsistent functional plans. There are multiple divisions there in the organization, they are not consistent. So that could be the reason why your strategies fail. Or perhaps the assumptions are wrong, but still assumptions are still right. Strategy is not formulated, getting changed substantially. Supporting functions are also aligned. Perhaps something to do with the resource allocation. You don't have enough people. For example, you want to bring your inventory down from 60 days to 30 days. You told what to do to each functional head. You told finance department what to do. You told your IT department what to do. You told your production department not to produce excess. You told your merchandising department not to order excess. So you told everybody what to do. So strategy was executed okay. There's nothing wrong with your initial assumptions also. So initial assumption that you made, okay, if you do all these activities A, B, C and D, you will be able to bring your inventory down from 60 days to 30 days. The problem has been sometimes the resources. IT department would have requested a modification to your system, which was not approved. Without this modification in your system, they are unable to provide certain reports that are required for you to measure. You would have requested additional people for the technical department or the merchandising department for them to exactly analyze this information and feed the management. Unfortunately, HR department did not provide that particular information or particular resources. So you're under-resourced. So probably something to do with the resources in the organization. Nothing to do with the execution, but you have not adequately resourced people. You have not given them adequate tools. So as a result of that, incorrect assessment of resource requirement could have led to strategic failure. So we ask the question, so we keep on asking the question, what went wrong? Is it something to do with your execution failure? No, it's not execution failure. We have executed the way we have agreed. Then is there something wrong with different departments? No, each department has executed the way that they have been briefed. Then your conclusion is there aren't enough resources in the organization to facilitate this execution. Then as a result of that, you don't get the reports, you don't get the analysis that you want. As a result, you will not be able to bring the system down. That is the reason. So you go and isolate what exactly went wrong, whether it's the incorrect assessment of the resources or not. Or it's something to do with your inconsistent financial plans, functional plans. Or it could be invalid planning basis. For example, your assumptions may be wrong. Likewise. So one way most of the strategies are getting wrong when they are poorly executed. Most of the time, about 80% of the time, the strategies are getting failed when they are executed poorly. So when you get to know that your strategies are not executed properly, you should ask the question why. Yes, the strategies were executed poorly. Then you need to ask the question why. Were the strategies and the requirement communicated effectively? Communication. Have you told your respective division what exactly need to be done? Have you told your production department not to produce extra? Have you told them clearly? Have you ordered have you communicated your finance department not to order the excess material? Have you communicated to your IT departments you need to have the periodic reports and the formats? Have you communicated your HR department to have extra people in this organization to support this initiative? If there is one link is missing, it's something to do with poor communication. So most of the time, just because you are not communicated properly your requirement, you have a strategy in place, you have an execution plan, but you have not communicated it to the respective department, there's the chances are your strategy may fail. Poor communication. Or perhaps you have communicated it properly, but you have not commit and follow through with the strategies. For example, has a CEO followed up this particular initiative on periodic manner? So you should be following up on weekly basis or monthly basis or quarterly basis or what's going on. Has the management followed this up? If the answer is no, strategy has failed because of weak commitment of the operational management. Management should have followed up. So there has to be a follow-up mechanism in place. So this is one reason for strategic failure. Third one, yes, were results monitored and strategies revised as needed? Are you frequently modified? For example, you measure and take corrective actions and again measure and take corrective measures. So do you go through this particular loop? If you don't, something to do with failure to establish proper feedback mechanism may be the conclusion. So likewise, there are many reasons why a strategy will not give you the desired results. And what you see here inside in this side is the possible reasons. Maybe due to poor communication. You have not communicated what is exactly expected from different people. Poor communication. It wasn't executed. Perhaps you have not committed. The operations management has not given enough commitment to make this action a reality. Perhaps the reason could have been failure to establish proper feedback mechanism. You don't have a way of measuring. Something to do with your inventive strategic planning basis. You are not formulated a strategy in the strategy correct in the first place. Sometimes you know what exactly the strategy is, you have executed it properly. Sometimes there are inconsistencies between the different departments. Finance department says something, IT department says something else, production department does something else, procurement department does something completely different. So inconsistent financial plans or the functional plans may lead into poor achievement of the actual results. Sometimes you incorrectly access the resource requirement. Okay, when you execute your strategy, you have certain requirement of resources in terms of money, people, and the systems. But your expectation, when you actually do the thing, you need more money to do. So that means you are unable to do it with the given budget. So incorrect assessment of the resource requirement may be another reason. So in reality, most of the strategies are getting failed due to mainly poor execution, and poor execution happens due to poor communication, poor commitment from the operating management, failure to establish a proper measuring system. Sometimes your strategy formulation basis itself is wrong. Sometimes you have not briefed the functional strategies accordingly. Sometimes you have incorrect resource requirement, and due to all these reasons, strategies could get failed. What is important is for you to understand what went wrong and take corrective actions and measure the performance against until you reach your desired objective. That is what is most important. Okay, so let's get back to appropriate measures. What needs to be measured at the very beginning, which is the first step of the evaluation control mechanism. Determine what to measure. So basically you need to measure the performance, and performance is the end result of the activity what you want to measure. Performance is measured. So some organization, as I mentioned to you earlier, have set certain level of performance criteria. So for example, in the airline industry, they measure cost per passenger mile. In the retail industry, they measure inventory turnover ratio. In the service industries, they measure customer satisfaction. In the telecom industry, they measure average revenue per user, ARPU. Right? In the financial services industry, you measure cost to income ratio. In apparel industry, you measure cost per minute. So likewise, different industries have different performance measures, what to measure. Basically, end result, what to measure. You may be measuring different things: absenteeism, labor turnover, rejects, number of accidents. There are so many things to measure, all are end result of the activity. Now, in order to measure these things, you may measure certain things. There are types of controls. Right? So there are three types of controls that you will come across in our organization. First one is output controls. Specify what is to be accomplished by focusing on the end result. This is what you measure at the end of the day. Output, you measure the output. You measure the output, and okay, you compare the output against the actual and tell whether it is good or bad. You measure the, let's say, weight of the child. It's an output control. You measure the weight and you compare against the actual. That is one way. You measure the rejects. You measure the percentage of rejects at the end of the period. You measure that. So sometimes it's difficult to measure things in advance. So that's why you measure things at the output level after it has taken place and then take corrective actions. So there are certain things, rejects, weight, height, things like that can be measured only at the output level. You measure the output, not the input or not the process, but you measure only the output. So that is one type of measurements are the output measures. You measure only the output so that you should be able to make the corrective actions once the things have taken place only. That's the drawback of this output measure. You measure only the output. Specify what is to be accomplished by focusing on an end result. So things that we measure, profit, gross profit, almost all the financial measures that we do are output controls. Inventory turnover, debtors period, creditors days, debt to equity ratio, profitability, gross margin, all these things are output controls. We measure once things have achieved. So specify what is to be accomplished by focusing on the end result. We measure the end result and we'll tell whether it is good or bad. That is output control. So almost all the financial controls or the financial measures that we do are output controls, not input controls. We measure things after the end result has taken place. Those are output controls. And most of the output, because it's easy to measure the output control. One of the reasons why people do measure output controls is because it's easy to measure. That is one of the reasons why do people measure output controls. The second type of control is behavioral controls. Specify how something is done through policies, rules, standard operating procedures, and orders from the supervisors. Now, in this case, you try to measure the behavior, not the output. You try to control the behavior of the people, and assuming if you control the behavior of the people or a process, you should be able to have a better output. Now, the classic example is ISO. What is ISO? International Standard Organization has specified certain ways of doing things, standard operating procedures. Now, for example, in your organizations, you have standard operating procedures. If I were to give a very basic example, if you want to order something, if you want to buy a computer for your organization, right? There is a standard operating procedure for that. If you want to buy a computer for the organization, if you are the user, you need to request. You usually request is through a purchase requisition, which is a procedure to follow. The first step is you request that I need to buy a laptop for me. Purchase requisition, right? Then it goes to whoever who has the authority to approve the requisition. Usually it is your HOD. For example, if in my organization, in my department, I want to buy if one of my subordinates wants to buy a laptop, I have to approve the request, purchase requisition. There I need to justify. Before approving, I ask this question: why do you need a laptop? Etc. etc. I ask all these questions and I approve whether if I am satisfied with that particular requirement. If I'm not satisfied with that particular requirement, I will reject that approval. Then after me, it goes to IT department. IT department will specify for that user what is the type of computer that is required, what is the size of the memory, what is the type of the screen, what is the type of the keyboard, etc. So IT department give you the specific technical specification that is there. Then it goes to the procurement department and they will ask for quotation. This is my requirement. I need to have a 40 GB RAM and this many keyboard. This is the type of the screen. This has to be the processing speed, etc. And you get quotations from different suppliers and you choose the best supplier based on the prices that you have chosen. So that is the procedure to follow when you are ordering something. Why? What is in the objective? You want to make sure you will not exceed your costs. End objective is to control your cost. Now you can measure the output control. Once all the laptops have been purchased, you will realize, my God, I have too many laptops in my organization. You cannot have output control for this kind of a measurement. Why? The things have taken place already. If you have only 200 employees in your organization, but you end up with 400 laptops, you cannot have output control, and it's meaningless to have output control at this stage. So in such situations, you have behavioral controls. You have a standard operating procedure to make sure things, you can take preventive actions before things gets wrong. That is one thing. Standard operating procedures. For anything you have, in most of the organizations you have SOPs, or standard operating procedures. The standard operating procedures like ISOs are behavioral controls. You try to control the behavior of the process. Now if you get into production flow, in the production flow, there are ways and means of handling. So the people in the production flow are trained to how to handle equipment, how to handle material, how to keep two pieces together and sew, how to apply gum, how to apply polish. And all the things have been taught, and they are not supposed to deviate from the procedure. The moment you deviate from the set procedure, you will have quality issues. So in the production flow, you have a standard way of operating, which is standard operating procedures, and the moment you deviate from that, you will either have quality issues, you will either have rejects. So one way to control your output is having behavioral control through standard operating procedures, orders from supervisors, and etc. Sometimes you have policies and rules. For example, one policy is that if you want to apply for leave, you need to inform that 2 days in advance. That's a rule as well as a policy. Why? If you don't do that, all of a sudden the absenteeism will go up and people will not turn up to work, so your production schedule will go for 6. So that is why you need to have policies and the rules. So the rules and the procedures, so for example, in time and the out time, which is a rule, you need to come to work at 8:30 or before that, and you can leave after 5. It's a rule. Why the rule is there? To make sure people come here and do work during the specified period. Those are rules. So another type of measurement is behavioral measurement. You measure whether people are coming to work on time, whether they are leaving on time, and you measure that. And if somebody is continuously not coming to work, if somebody is coming to work late every day, then you have to take disciplinary actions against that particular person. Why? It is not an acceptable way of performance. So that's the second type of control, behavioral control. So you have two types of control: output controls and the behavioral controls. You can get one step further and you can start controlling the inputs. You control the inputs. Now, when we are recruiting an employee, right? If you want to recruit an employee, again, there's a procedures to follow, behavioral procedure. So you need to get the certain approvals before recruit somebody, which is a behavioral control. You need to ensure that you have the right amount of people in the organization. Now, once you get the approval to get a new person to the organization, you carry out interviews. Why do you have to interview people? to assess whether they are capable of doing the assigned job. You interview the people and see, okay, whether these people have certain level of capabilities to perform these particular tasks, which is an input control. You check at the very input level at the interview whether this particular person is capable of doing this particular job. That's the input control. You control the input there. Before him coming to the system, before that particular person employee get recruited, you check whether this particular person is capable of doing this particular job. How do you assess that? One way to assess that is qualifications. For example, if you want to recruit an accountant, obviously that particular person should have a basic accounting qualification or a degree in accounting. That's the input control. If you recruit an IT person for that particular job, it's not going to work because IT person will not have the competencies required to do a finance job or accountant's job. So input control itself reject the IT person coming into accounting profession. That's the input control, right? So likewise, that's the input control. Now, this is mainly done, especially in the knowledge workers, because you cannot really measure the output of a knowledge worker. If you have an accountant or a finance manager, you cannot simply measure the output of the accountant. Output of a accountant or the finance manager, you cannot measure. Output of your general manager cannot be measured. Output controls. No, it doesn't work. But if it's for a shop level employee, you can measure the output control, how many pieces that he produces. You can measure the output control of a shop level person, but when you become very senior, general manager or a CEO, you cannot measure the input control. You cannot measure the output control. So in such situations, you need to measure the input controls. So one way to measure the input controls is you specify the experience. In order to become a general manager, you need to have 15 years of experience in the similar industry. That's a input control. You need to have a basic degree and a master's degree. Again, people that caliber will only be able to do this particular job. Input control. Because you cannot measure the output, you measure the input, especially when it comes to knowledge workers. For example, if the university wants to recruit a lecturer, you cannot measure the output control of a lecturer, because unless and otherwise you get into the system and measure the quality of the delivery, you cannot measure that. So they have input controls. You need to have a PhD. You need to have published this many research papers. You need to have this much of industry experience in order to do this. So those are input controls. So when you are measuring performance, you can measure performance at the output control level, output level. You can measure the performance at the behavior level through policies, rules, and the standard operating procedures, or you measure the inputs. Another way to measure the input control is your material quality inspection. It's an input control. Once the material comes to your warehouse, before it goes to production room, you do a sample check. You measure the sample quality. And if the sample is getting failed, then you reject the whole material batch. Why? It's an input control. Before things get damaged, you measure the input. So material quality inspection is again an input control. You can have so many measures like that. So usually you have these three types of control in your business. Again, a little bit of finance. When you are measuring performance, you need to do something called activity-based costing. There are two types of measures. Traditional measure absorbs overheads depending on certain predetermined standards. For example, in traditional cost accounting, you absorb overheads based on either the machine hours or based on either labor hours. But in activity-based costing, what you actually do is allocate indirect and the direct costs to individual product lines based on the activities going into that particular product. You allocate cost based on the activities, not based on the arbitrary activities. Now let's look at this particular example. So there's a company called Busy Ball. They make two types of bouncing balls. One has a hollow center and other has a solid center. You use the same equipment to produce two types of balls, but not at the same time, but you use two different runs. And obviously between the batches, the equipments are cleaned, maintained and set up for the next batch. When it comes to packaging, hollow center balls are packaged with two balls per package. And the solid center balls are packaged one per package. So there's a difference. Now during the year, Busy Ball expects to make 1 million hollow center balls and 2 million solid center balls. So overhead cost is total 1.4 million. And it has been broken down into different types. Total overhead cost is 1.4 million. And it has been broken down to different activities. Purchasing of material, machine setup cost is 350,000, packaging is 300,000, testing is 270,000, cleaning and maintenance is 288,000. So that is how this total overhead cost has been broken down. So what is happening in activity-based costing is that your total cost is broken down into different sub-activities. What are the activities? Setting up, purchasing, packaging and testing, and cleaning and maintenance. Okay, so what drives the purchase of material? So you are planning to spend $200,000 for plan, and obviously it is a number of cost drivers. So what is important in the activity-based costing is there's something called cost drivers. What actually drives this cost is purchase orders. So there are 100 purchase orders to be raised for 200,000. So cost per purchase order will become $2,000. Similarly, machine setup cost is $250,000, and obviously it is driven by the number of setups. So there are 252 machine setups has been planned. So the cost per machine setup is 1,390. So likewise you can calculate the cost per different setup. For example, if you look at the packaging, again you can look at total cost is 300,000. You need 2.5 million container fills. So cost per driver is 0.12. Likewise, you can calculate for each cost driver what's the cost going to be. So that is the fundamental principle in activity-based costing. You break down all the overhead cost into different set of activities and you calculate the cost per activity. This is important. This is very much important when it comes to performance measurement. I will tell you the reason in a little while. Now, if we apply the activity-based costing for the hollow center balls and the solid center board. Now, for example, look at the purchasing activity. What is the cost driver? Purchase orders. Cost per purchase order is $2,000. Hollow center balls require 50 purchase orders and solid center requires 50 purchase orders. So we have allocated the purchasing cost into hollow center balls and the solid center balls based on the purchase orders, $100,000 each. Again, the setup cost has been allocated to hollow center and the solid center based on the activity-based costing. Packaging has been allocated. Let's see the difference. Hollow center requires less packaging and solid center requires more packaging. So as a result, solid center has been allocated a higher cost and hollow center has been allocated a lower cost, simply because the packaging is different. Testing, hollow center required only one test, whereas solid center required two tests. So the costs are different. Cleaning and maintenance, hollow center required less production runs, whereas solid center required more production runs. So the cost is different. So the total cost of hollow center is 521, whereas the solid center is 881. The total remains the same. Total remains the same. So total is 1.4 million. 1.4 million has been broken down into hollow center and the solid center separately based on different activities that it goes through. And you will now see cost per hollow center ball is $0.521. 521 divided by 1 million, whereas cost per solid center ball is, yes, 0.044. This is if you do the calculation by the activity based costing. So what is the basic principle of activity based costing? All the overhead costs are broken down into different activities. There are purchasing activities, setup activities, packaging and the testing. And then you calculate the cost per cost driver and allocate different costs based on the different level of activities. And then you calculate cost per unit based on activity based costing. Traditional method is, as I mentioned to you earlier, you calculate the total overhead cost and divided it by direct labor hours and you calculate the cost per direct labor hour, 0.932. So if you look at hollow center ball, cost is 0.932 per labor hour and you multiply it by the number of labor hours and you get 0.352 overheads per hour. And here you get 0.528 overheads per hour if you go by the traditional method. Okay, now here you have the comparison. Hollow center ball, if you do the costing as per the traditional method, it is going to cost us 0.35. However, if you do the activity based costing, it is going to cost us 0.52. Solid center ball, if you do the traditional method, it's going to cost us 0.53. However, if you do the solid center ball, if you do it activity based costing, 0.44. Imagine if you don't use activity based costing and use traditional method for costing. Hollow center ball is under cost, whereas solid center ball is over cost. However, if you do the activity based costing, you will be able to get the real pricing. So again, you need to be really careful when doing traditional accounting or traditional management accounting principles and the costings when you are measuring performances. So you need to get into very finer details and get into activity based costing, and then only you should be able to measure the performance. So that is one particular learning coming from activity based performance. Right. So we shall take a small break and we shall continue in 10 minutes after taking this particular break. Right. Good afternoon, everybody. Can you all hear me? Yes, please. Can you all hear me? Okay, thank you. Right. So now we are getting into a different aspects of performance measurement, which is known as enterprise risk management. Now, you would have probably heard about in corporate governance section, chapter 2 or chapter 3, if I recall correct. There is an aspect of risk management there as well, the governance. Uh, because this is simply coming from the perspective of the agency principal relations. For example, there are principals, the shareholders who hire agents or the top management for that matter to run their business on behalf of them. And there has to be some kind of assurance to the principals that the agents are fulfilling their duties or discharging their duties according to the requirements of the principals or the shareholders for that matter. So the whole principle, whole concept of corporate governance is stemming out of that particular element, and it is being executed in the organizations through the internal audit department, as well as through risk committees, as well as the audit committees, etc. So basically, there's audit committee in any large organization, which is sub committee of a board, which eventually assess the all the risk related elements of the business and report to the board of directors on quarterly basis or based on a predetermined interval. There's a performance measuring element also when it comes to risk management. So basically, the risk management is kind of a becoming important topic in today's business context. Because today's business processes are getting so complex, and there are so much of risk, and basically when you're dealing with multinationals and you're dealing with multiple countries, different type of customers, different environmental types are there. So likewise, as a result, the business environment is getting complex on daily basis, especially in today's context. So there is a new dimension in strategic management, which is known as enterprise risk management, which is known as a corporate-wide integrated process of managing uncertainties that could negatively or positively influence the achievement of the objectives. Now, you set out your strategy and you go and execute it. In the process of execution, you may have so much of uncertainties and the risks involved. Now, if I give you a basic example of a risk, is that, for example, you want to buy a car, and the moment you put the car on the road, you have a risk of meeting with an accident with another vehicle. That's a typical risk, right? So typical risk mitigation technique that we use is the insurance in that matter. So likewise, in a business also, there are multiple risks involved. I give you an analogy between the personal life and the business. If you get into a vehicle, yes, there's a chance of getting meeting with an accident. So you cover that risk through insurance. So likewise, in business also, you may have multiple risks that you are exposed to. Some risks you are aware of, and some risks you don't know what's going to happen. So one aspect of performance management is that how good you are identifying the risks that are associated with the business, and how good you are planning to mitigate that. That is what is meant by enterprise risk management. Now, if you look at if you are a retailer, now for example, if you are having inventory in multiple locations which you don't present, the biggest risk that you have is the fraud. Risk of fraud, because you are present in multiple retail locations, you don't have direct control of them. So the immediate risk is the risk of fraud. If you are working in the banking industry or the financial institution, one of the biggest risks is risk of default. If the customers who obtain loans don't settle their loans on time, you are running out of you are running a risk of losing your money. That's the risk. So likewise, different risks business have different risks involved. So first step is identifying the enterprise risk management is identify the risks. Identifying what are the risks that will be there in the business. Perhaps, if possible, to identify the possible future risks, which is a more difficult thing. Now, so that is the first step, identification of the risks, and you use different techniques. One thing is the brainstorming. You get the entire senior leadership team into one room and ask them to come up with types of risks that the business has. Brainstorming. That is one type of brainstorming. Or you could have scenario analysis. If you do scenario A, now for example, let's say you want to convert, because you are in retail business, you want to convert your direct operation to a distributor model. That scenario. If you go to scenario 1, what are the risks associated with that scenario? So you plan by scenario and you identify the risks. Or perhaps you may get performing risk assessments. You may get professionals or consultancy firms who are specialized in this, and they have experience in multiple businesses, and you measure the risks to your business based on that. So basically you may list down at the end of this particular exercise, you may list down the types of risks that you may have in your business. Then the next step is rank the risks. Not all are equally likely, and if that happens, the impact is also very different. So you may rank the risk based on the impact it would create and the likelihood it happens. Now, for example, I'm just giving an example. Now, you build a house, right? What are the risks that are associated with that particular house? Is that one thing is that burglary. That is one type of risk. Burglars may enter your house and take your valuable property. That is one type of risk. Secondly, the risk of fire. There may be a fire that may erupt in your house, so it could destroy your property. Number 2. Third one is, okay, the aircraft may accidentally land on your house, so that house get destroyed. Now I have identified 3 types of risks. Risk of burglary, risk of fire. Third one is an aircraft landing on your house and getting it destroyed. The fourth one could be you're getting caught to let's say floods. Your house is getting caught to a flood, and as a result it could get destroyed. It had happened about a couple of months back in Sri Lanka as well. So there are 4 types of risks that are involved. Then you need to assess what is the likelihood of happening these particular risks. How likely that a particular risk to happen. Now, a burglary attack is highly likely. Burglary attack is something that is highly likely in your house, out of the 4 risks that I mentioned. Then erupting a fire, yes, there is a chance, but less likely compared to a burglary attack. Then the flood, if you are in the flood prone location, there's a high chance, but if you are in a different elevation, or if you are in a high elevation, it is highly unlikely to happen. Landing an aircraft from your house is one of the least possible things that could happen. So likewise, you could rank these 4 risks based on the likelihood. That is one way. Likelihoods from highly likely to least likely. Then if a particular thing happens, what is going to be the impact? Now if the burglar enters your house, what is the impact? He may take the electronic items, he may take the jewelry, so you may assign a value into it. So what is the value at stake if a burglar enters your house? If your house get caught into a fire, what is the impact? If there's a flood that is coming to your, if you get hit with a flood, what is the impact? And obviously if an aircraft land on your house, what is going to be the impact? Likewise, you may rank risk based on the likelihood of risk occurring as well as the impact, because you cannot plan for almost all the risks. Once you do this exercise, you may see there are some risks, there's a high possibility of happening, and if that happens, there's a large potential damage. At the same time, you will realize there are some risks very unlikely to happen, and it is highly unfortunate if that's, for example, landing an aircraft on your house is very unlikely event to happen, but it happens, then you are gone. Impact is very high. So there are events, impact is very high, but highly unlikely to happen. So you may rank this particular matrix. Then you decide what appropriate actions am I taking. Okay, now if I see a burglar enters into my house and there's a high chance of losing my money, perhaps you may have different options. Install a CCTV camera, get a security guard, get a burglar insurance, etc. So those are the options that you have, right? Perhaps if there is a high chance of fire, you may decide to have a fire alarm system or fire extinguisher, perhaps fire insurance, and all these things can be taken. So periodically, you need to keep on monitoring these risks and updating your risk matrix. There may be risks that was there earlier may not be relevant now, but there may be new risks that was not there earlier but may be relevant for you now. So you need to periodically measure the risks, and time to time you need to take appropriate actions. You need to measure and keep on updating your risk matrix. So not only financial performance, you need to measure non-financial element like risk as well. So you need to decide what to measure using a particular risk matrix. That is another dimension into it. So there are some of the primary measures of corporate performance. You are familiar with all these terms: return on investment, earnings per share, return on equity, operating cash flow, or free cash flow, etc. So these are the primary measures of corporate performance. I'm sure you are familiar with these terms. Again, all these things are financial measures. At the same time, those are more of output level information, because you will get to know things once it happens only. So these are more of a output level measurements. Similarly, there are non-financial measures as well. Actually, the couple of decades back, companies was really measuring only the financial measures, things that I mentioned you earlier: ROI, earnings per share, gross profit margin, profitability, return on equity, return on investment, likewise. Now the companies are increasingly measuring non-financial factors as well. Along with the financial factors, they measure non-financial measures as well. Now, for example, especially the internet companies like Facebook, Twitter, LinkedIn, they have complete set of non-financial measures like stickiness. How customers continue to engage with your network. Stickiness. For example, it can be in the Facebook, it can be measured by number of likes. Stickiness. How frequently somebody is uploading his Facebook profile. Stickiness. Eyeballs. Number of people who are watching a particular post. How many people has viewed your profile? How many people have viewed your application? How many people have viewed your update? Number of eyeballs. Mind share. Top of the in marketing, there's something called top of the mind record. So this is measured. For example, if you want to buy a mobile phone, what comes to your mind first? In Sri Lanka, people will definitely say dialogue because it is the top of the mind. They have the highest mind share. Insurance companies. What is the company that you want to buy insurance from if you want to have insurance? Mind share. What comes to you first? Perhaps, probably Sri Lankan insurance or Sri Lankan insurance. I don't know. So likewise, mind share. Then you go by the monthly unique viewers. If it's especially for websites, you measure how many people have how many unique users have viewed my measure. So these are some of the important measures in non-financial measures. Again, when it comes to performance measures, ROI or return on investment uh, has been used by most of the companies and most of the organizations and most of the investors. So it's worthwhile spending some time to understand what is return on investment and what are these advantages and what are the limitations of using this as a corporate performance measure. Again, return on investment is a financial measure. You measure the return or the profit before interest and tax divided by the capital employed, which is known as the return on investment. The total amount of money that you invested is the denominator, and the numerator you have how much do you earn on an annual basis, return on investment, which is a more of a financial measure, and higher the return on investment, the better the performance it is. That is the usual guideline. So higher return on investment is always preferred. You don't have to have multiple measures. ROI can be considered as one single measure that tells you the corporate profitability, corporate performance. You don't have to have multiple measures. You don't have to look at revenue, cost, expenses, gross profit margin, debt to equity ratio, gearing ratio, then liability ratios, current ratios. You don't have to look at all these ratios. This single dimension, one ROI, will tell you whether the business is successful or not. So one of the major advantage of ROI is a single measure. It's like a single index that you tell about the entire corporate performance. One of the advantages is that if you have multiple divisions, multiple SBUs or strategic business units. Now, for example, Haley's, for example, has 200 different companies. So you can measure the performance between the organizations using ROI. ROI of company A, ROI of hotel sector versus ROI of telecommunication sector versus ROI of supermarket chain. Likewise, can be compared. Also, it can be compared across companies in different sectors. So likewise, there are many advantages of ROI as a single financial measure. There are many limitations as is because it's limited by the financial accounting, because it's governed by the financial accounting, and as a result, your profitability, the way you report your profitability measures. One of the major limitations in the ROI is that it is very sensitive to depreciation policy. For example, if you have accelerated depreciation, if you depreciate your assets faster, ROI can be improved. Whereas if you have a slow depreciation policy or a very liberal depreciation policy, then ROI will be lower. That is one thing. And also it could discourage investment in new facilities. With the moment you invest on new facilities, what's going to happen is your asset base goes up. You don't get a return immediately. So your ROI tend to come down in the short run. Or even if you upgrade the old one, immediately you have a capex. As a result, your asset base goes up, but you don't get a return immediately. So it may discourage some investments in new facilities as well as upgrading old ones. And as a result, in the long run, there's a tendency that you may lose because you are looking at more of a short-term measure. If you are measured by ROI purely because of your accounting practice, you will not be able to do so. So likewise, it provides incentives, especially in the transfer pricing. when the transfer pricing are set between the divisions, it could incentivize the division manager to set transfer prices at a higher possible price, because they will get a higher return and with the same level of assets, and they will always lobby for in-house transfer rather than by purchasing from outside. And ROI is more of a short-term measure. In the long run, you may have different things to look at. Again, your inventory practices, whether you are following a LIFO or FIFO, and the inflation, it gets changed. So if you are measuring your business performance solely on ROI, then you need to be really careful having a single measure. So actually, this is what has been practiced historically, ROI. All the performance were measured simply by looking at ROI. And sometimes later people found that, look, this measure is useless because we are cheating ourselves in the short run by trying to improve our ROI, but in the long run we are losing. And also it's a pure financial measure. As you will well aware by now, financial statement will not capture the entire full picture of the business. So there was a requirement to measure performance using broad set of indexes. Broad set of indexes. Obviously, you look at the financial perspective, but you try to introduce some other elements as well. So which is known as stakeholder scorecard. You measure your performance depending on the type of stakeholders that you engage with. And you have two types of measures, short-term measures as well as long-term measures. Now, ROI is a very single measure, it's easy to understand, easy to explain, whereas when you're having multiple measures like stakeholder category, the short-term and near-short-term, it's become a kind of a complex exercise. And also the recent development in this particular area is something called balanced scorecard, which I'm going to touch in a little while, right? So basically, in the modern organization, when they are measuring performance, they look at two types of performance measures, short-term measures as well as long-term measures. And also they look at from the different perspective. Now if you look at this table 11.2, stakeholder category, customer. Possible short-term measure is number of new customers, trials, sales and volumes. Long-term measures are growth in sales, your ability to control price, turnover, customer base. Then financial, obviously you have the typical EPS, ROE, growth, etc. Then employee dimension, which has never been part of our traditional performance measurement. Number of suggestions, productivity, number of grievances, in the long run, number of internal promotions, turnover. Likewise, the environmentalist, number of meetings, number of changes to policy. Likewise, you try to bring multiple dimensions into it and you measure that. So it is known as measuring performance. So the modern organization now measure not only the financial performance, but along with the financial performance, multiple dimensions into it. Again, now you really don't talk about, there's something called shareholder value. And you talk about the value of the organization instead of returns these days. Now in corporate finance, you would have heard the valuation of a company. Company valuation. And the company valuation, what is happening is, in the corporate finance you will learn the more details. Company's value can be identified by calculating the present value of the future cash flows of the organization, which is what is known as the shareholder value of the organization. Now, in modern organization or modern management theories, what you're trying to do is you're trying to increase the value of the organization. Wherever possible, whatever the actions that you're trying to do, you're trying to create the value or enhance the value of the organization. We call shareholder value creation. Now, this is the latest concept in strategic management or financial management is you try to enhance the value of the organization, not try to increase the return, but you're trying to enhance the value of the organization. And so the value is more of a long-term thing. So value, if you do certain actions today, that will help you to generate future cash flows, and naturally such activities will be able to generate high value for your shareholders. So there are two concepts under this measuring value. There's something called economic value added, EVA. So basically, economic value added measures after tax income minus total annual cost of capital. So basically, if you deduct the after tax income of the company and minus your cost of capital, if you have something left, which is known as economic value added. Basically every year your after tax income should be more than your cost of earning the particular capital. So basically, if you look at cost of capital, there are two components: cost of equity and the cost of debt. And you have something called weighted average cost of capital. So in a given year, you have a after tax income, and from that, if you take out the cost of funding, weighted average cost of funding, the remaining component is known as economic value added. That means if you, after taking out your profits, if you deduct your cost of providing that particular capital, then it can be considered as you are adding economic value to the shareholder. Again, it's a more of a short-term measure because you are measuring it on annual basis. Because you are taking into account annual after-tax income. It's a more of a short-term measure. The second measure that measures the value creation is something known as market value added. Again, it's a more long-term measure. This measures the difference between the market value of a company and the cost of capital. So difference between market value of the company and the cost of capital of the same. If the cost of capital is less than the market value, again, it can be considered as particular company is adding value to the market. So these are the latest concepts in management. So you go by the value creation and you are moving away from the return perspective. You are trying to measure the value creation, shareholder value. Whatever the actions that you do, you're trying to enhance the value to the shareholders. And there are again two types of measures. Again, there's a short-term measure called economic value added. You measure the after-tax income minus the cost of capital, and it's a positive balance. We call there's a economic value addition. Or else you can go by the market value added, where the difference between the market value of the organization and the cost of capital will give you the market value added. And the balance scorecard, as I mentioned to you earlier, companies are increasingly moving away from companies are moving away from relying on financial statements completely to measure the performance. Instead of that, they have multiple dimension or kind of a scorecard. If you look at the scoreboard in if you look at a scoreboard in a cricket match, it has a lot of information. It has information about the current batsman, number of overs bowled, who's going to bat, and etc. You have a lot of information, not only single information. So increasingly companies are looking at multiple dimensions to look at the business performance. Earlier they have been completely relying on the financial accounting information, return on investment, ROE, earnings per share, etc. Now, keeping the financial element the same, now companies are increasingly adding certain other dimensions like customer perspective, innovation and learning, internal business perspective. So basically, balance scorecard is a kind of a combination. It combines financial measures with the customer satisfaction and internal processes and etc. So you have a combination of financial as well as non-financial factors embedded into your performance measurement system, so that when you are looking at something, you're not blindly looking at the financial information, but you're looking at the non-financial aspect as well. So if I get into the details of constructing a balance scorecard, now mainly scorecard contains 4 sections. You have the financial section, customers dimension, internal business processes, and the learning and growth. So basically, financial section measures how strong you are financially. Financial section measures how strong you are financially. So your objectives are achieve ROCE, asset utilization, profitability, cost leader, profitable growth. So these are your objectives. Your measures could be ROCE of 18%. You measure financial, whether you are financially strong or not, by measuring ROCE, and you have a target ROCE of 18%. Then it's a kind of a N year measure. So every year you measure your ROCE. Likewise, again you measure your cash flow. Your target is to have $500 million cash flow. Again, financial stability is can be measured using net margin of 11. Full cost per gallon, volume growth, premium ratio, non-gasoline revenue. This can be done for a petroleum company. So likewise, you have different targets to achieve. Then that is the financial perspective. So earlier, historically, the company's performance has been completely measured on the financial point of view. You look at only the financial perspective. If you're okay, then it is considered okay. Nowadays, it is not enough. Now there's a customer. For example, you have here under financial, you have a measure called volume growth. For you to achieve volume growth, there has to be a customer who will continue to buy from you. To do that, you need to delight the customer. So that is the customer perspective. So you look at the performance, you measure the performance from the customer perspective. Objectives are delight the customer, build win-win relationships with dealers. If you are dealing with a dealer or third party to deal with your end customer, build win-win relationship with your dealer. That is your objectives. So how do you measure? Share of segment, market share measurement. Mystery shopper rating. You run a mystery shopper program and you get a rating. You want to achieve a particular 4.5 rating. Dealer gross profit growth of 25%. How do you run this? You initiate mystery shopper program and you manage a dealer committee to engage with the dealer continuous basis. If you don't have this, it sometimes may be difficult for you to achieve the volume growth mentioned on the financial perspective. So financial perspective as well as customer perspectives are linked to each other. In order to sell more, you should have delighted customers. So if you see your mystery shopper ratings and the share of segments are coming down in the future, that means you should expect your financial performance to suffer. Then the third dimension is internal perspective. What do you do internally in order to, what is your internal plan? What is your internal structure? So for example, build franchise, increase customer value, operational excellence, good neighbor, new products, etc. And your employees, climate surveys, employee surveys. So likewise, you look at financial, customer, internal as well as learning and growth. So again, Measuring the performance of the top executives also, the balance scorecard framework can be used. So it is increasingly being used right now, the balance scorecard framework, to measure the performance of the senior executives like top management. So here you will see the balance scorecard, how balance scorecard and the strategy is getting linked to each other. Now your financial perspective is to increase profitability. Financial perspective is to increase the profitability. So objective is increase profitability, increase revenue, manage development expenses and ROI. Right? So to manage in development expenses, ROI, or increase revenue, you need to have a customer. So then strengthen customer interactions. Through that, improve customer value. How do you do that? Improve market assessment, improve product lifecycle management, improve concept development, etc. Then you need to have the organizational capacity, improve innovation culture, enhance partnerships. So all these things can be improved. So this is a sample of balance scorecard. So all these things can be embedded in order to achieve your final objective of strategy, which is increase profitability. Again, you can have the divisional as well as functional performance, especially in the budgets. You measure the responsibility budget, responsibility centers. This is used to isolate a unit, so it can be evaluated separately from the rest of the corporation. So inside your organization, you have different types of responsibility centers, cost centers, revenue centers. For example, your sales department is a revenue center. Then there are expense centers such as HR, IT, marketing, administration, etc. Those are expense centers. So they are managing it through a budget. Administration budget is this much. Profit center, again, one SBU could be a profit center. Then you have investment centers. So if some organization have the ability to invest, these are known as investment centers as well. Then another way to measure the performance is benchmarking. Benchmarking is you compare yourself against your industry peers, which is known as a continuous process of measuring products, services and practice against the competitors of those companies in the industry. For example, in that case, Dialog could measure their performance against SLT, because these are the companies who are in the same industry. Unilever could compare themselves against, let's say, Nestle, could benchmark their processes. Likewise. So there are steps involved in benchmarking. The first step is identify the area of process to be examined. Let's say financial performance needs to be examined. Find behavioral and output measured. Now, for example, Unilever has its gross profit margin, ROI, return on equity, then likewise. So then output measures can be selected. Select the accessible set of competitors of best practices. Obviously, it's financial measures, you need to get hold of the annual report. Calculate the differences among the company's performance measurements and those of the competitors and determine why the difference exists. And then if you see Unilever gross profit margin is very low compared to, let's say, Nestle's, then develop a tactical programs for closing the performance gaps. Then implement the program and complete the results. So that's basically the performance measurement technique. Again, when it comes to international practices, ROI is still being used as one of the widely used technique. Some companies use budgets to measure the performance. Some companies use historical compared to last 3 years, how we are doing now or less. Or finally, the international transfer pricing are some international measurement issues. Also, information systems needs to play a very vital role in modern day measuring performance, because your information systems should be able to capture and analyze and provide information that is required to measure the performance of the organization. So most of the companies are actually failing at this stage. They have their ERP systems. Now increasingly most of the companies are using ERP systems, which is good because it captures all the information, everywhere in the organization in one single location, in a single familiar software, and whenever they need information, somebody can easily access throughout the organization. That's the whole concept of ERP. So when it comes to performance management, actually ERP plays a very vital role, because information can be managed, accessed, and disseminated to the required party through a ERP system. If you properly implement ERP system, it will make your performance measurement very high. If you make your performance measurements very easy. Also, in the supply chain management, especially in the retail industry, to measure your inventory, RFID or the radio frequency identification is being used. So you could measure the movements of the items, as well as the location tracking, etc., can be done through the new techniques called RFID. Now, for example, DHL, or they can easily track where your item is. They will send you periodic update if you get into a DHL website. If you give you a tracking number, they will tell you exactly or they will give you kind of a proposed tentative arrival date, as well as where the particular equipment is right now. So that is, when it comes to supply chain efficiency, you can use new technology to enhance the services. Then you have the divisional and functional IS supposed. Information system is very much essential when developing when it comes to performance management. There are many problems in measurement performance. One thing is lack of quantifiable objectives or performance standards. Some company wants to measure their performance, but they find it difficult to explain, quantify, or define what are the performance standards are. So this is where actually most of the failure happens, because when you are developing a ERP or when you are developing an information system, you need to tell information system this is exactly what I want, right? And most of the organization at the implementation of the ERP or the information system fail to define what exactly they need for the performance measurement. And as a result, once you implement the ERPs, it is difficult to get the information you want to run the business or to measure the performance. So main problem in measuring performance is not having right information, not having right systems to get the information that you want. Most organizations are having information system and ERPs, but unfortunately, most of these organizations do not have necessary information for them to measure the performance. Sometimes it's pity, because to have a performance measurement system, unless and otherwise you communicate it to your ERP system or information system or management information system, you will not get the desired output that you want. So one thing we need to keep in mind is that there has to be a very clear communication between your IT department as well as your business divisions. You need to tell IT department what exactly needs to be measured and document those things prior to implement any IS, prior to implement any system or ERP. Otherwise, once you implement ERP, you have a nice ERP, nice information system, but it does not deliver what the business wants. I have seen it happening in many organizations. You will not be able to minimize this unless you have the information gaps, because the information needs for the business are getting changed. But what you need to do is you need to periodically plan these things and periodically upgrade your systems and the processes in order to capture relevant information. Another major problem in performance measurement is it's more short-term oriented. Managers only consider current tactical or operational issues and ignore the long-term issues, simply because managers are overloaded with tactical as well as operational issues, so they don't really simply have time to think about long-term as well as strategic issues. Simply lack of time. They have 8-9 hours of work and so many meetings, so many priorities to attend, so they will not have time to think about long-term. That is one of the main problem in the organization. Even at the top level, CEOs, the managing directors and the GMs are getting involved in the operational issues, so they don't have time to think about the future, long-term strategic issues. And sometimes people don't recognize the importance of long-term issues. And again, when it comes to appraisals, again, they are rewarded mainly for the achievement of the short-term objectives, not really on the long-term objectives. So aligning your reward mechanism or the reward policy with a mix of short-term as well as long-term objectives is the best way to do, but it's very challenging to achieve so, because of these reasons. Most of the organizations are very short-term oriented. They run the business from P&L to P&L, year to year. So there is no incentive for somebody to think long-term. That is another problem in performance measurement. Another problem is the goals displacement. Confusion of the means with ends. So especially goal displacement. For example, in soccer, there's a clear goal. Everybody wants to play for a goal. There's a clearly defined task and the goal. So sometimes in the organization, end goal is sometimes not really clear to the managers. One day managing director comes and tells us about the profitability. Another day he comes and tells about sales growth. A couple of weeks later he comes and talks about cost reductions. Then he talks about revenue growth. So sometimes the managers are confused what exactly need to be done, which is known as goal displacement, confusion. So as a result, what we are trying to do is, when the top management is sending confusing signals or the directions, the next level, they are trying to sub-optimize. So they try to achieve the organization, my objectives. Okay, now there is no clear goal to the organization. Even though there is a goal defined, it is not clear. Let me try to do what I want the most, I am comfortable at, which is what is known as sub-optimization. So you are trying to optimize your division's performance at the expense of somebody else's division. Now, for example, sales department as well as finance department has this fight always. Finance department is responsible to maintain healthy working capital to minimize the interest cost down, as well as maintain a decent debt to equity ratio. Now, one way to minimize your debt to equity ratio as well as interest rate is controlling our working capital. There are two ways to control your working capital. One thing is to cut down the inventory or cut down the debtors. Let's say as a finance manager, you want to cut down your debtors period from 45 days to 30 days. As a finance manager, you are very happy because that will enhance your objectives. You should be able to maintain a very good working capital. You will be able to maintain very good cash flow. You will be able to maintain very low level of interest expenses. as well as you will be able to maintain a very low level of gearing ratio if you do so. The moment you try to do this, your sales guys are suffering. Why? Sales guys, his competitor is giving 45 days of credit. Now your organization is giving 30 days. So your sales guys are immediately at a disadvantage. But as a finance manager, you are very comfortable. So which is known as sub-optimization. One unit optimizing its goals, finance division is optimizing its goals, and as a result, the sales division is suffering at the detrimental of the organization as a whole, because when the sales suffer, the whole organization suffers. That is the sub-optimization. Sometimes the other way around also happens. The credit or the sales guys keep on extending credits, so they will do enough and more sales, so their performance are guaranteed and achieved, they get their bonuses. Whole organization is losing the profitability, which is also known as sub-optimization. So you need to be really clear what is exactly the goal should be. And there's something called substitution, behavioral substitution. And sometimes if you reward the wrong activities, and again people will substitute activities that do not lead to goal accomplishment. Now for example, if there's a particular salesman who's continuously achieving his sales targets by extending credits. So there's a salesperson who is achieving his sales targets by continuously giving credits. In the same division, there's another salesperson who does not reach his targets, but he is well within his credit limits. He does not extend his credits, so his bad debts are lower. Now from these two people, the person who does high amount of sales are getting recognized on daily basis, monthly basis, whereas the person does not really meet the target but who manages credit according to the guidelines is not getting rewarded. Eventually what is happening is the other salesperson who did not sort of compromise credit quality to achieve targets slowly will relax his credit terms so that he will also reach targets, which is known as behavioral substitution. When people substitute activities that do not lead to goal accomplishment, but since you are getting rewarded for that, you simply do it. This is what is known as goal displacement. So these are some of the issues that will be there in performance management. And when you're designing controls, you need to keep these things in mind. Control should involve only the minimum amount of information. Because for example, you may design a control which needs a lot of information, it's never going to work. Control should involve only minimum amount of information so you can easily extract, easily measure. Number 2 is control should monitor only meaningful activities and results regardless of measurement difficulty. Because sometimes in an organization, we measure easy things to monitor. So sales growth is easy to measure. We monitor that. But we don't measure customer satisfaction. This is difficult to measure. We don't measure the brand equity because it's a difficult thing to measure. But these are meaningful things. But simply because certain activities are difficult to measure, we don't measure in the organization, which should be avoided. Then third one, control should be timely so that corrective action can be taken before it's too late. If there are things that needs to be measured on weekly basis, you should measure it on weekly basis, so that you could take timely action. For example, if your absenteeism is high and you don't have to wait till the year end to fix that, you measure it on weekly basis and corrective actions can be taken immediately. Otherwise, you have to wait for a year to do so. Control should aim at pinpointing exemptions. Yes, every rule should have an exemption, and those you should have a flexibility to handle exceptions with the right level of approvals. And also your reward structure should emphasize on meeting or exceeding standards rather than punishing for failing to meet standards. So you should reward people always for meeting and exceeding standards rather than penalizing it. So there it comes, the incentive management. So there are different ways of managing incentives. One thing is the weighted factor method. When you have multiple objectives, you have allocated weightages. For example, if you are measuring performance of a salesperson, two factors you can consider is sales growth as well as his collection. So you may decide to give higher percentages to sales, 60% to sales and 40% to credit collection. Some organization may decide to give 80% to sales and 20% to collection. So you may decide, which is what is known as weighted factor method. Then there's a method called long-term evaluation method, especially if you are in the corporate sales. Your performance can be measured not only on sales, but how many contracts you are getting renewed. Long-term evaluation method. That is one way. There's something called strategic funds method, which is not being used in Sri Lanka. Actually, it's difficult to implement because you create a fund and you ask contribute to individuals put to a particular fund. So you have a pool of funds. So your bonuses are getting accumulated over a period of time. So you are not getting the full bonus, but gets carried forward for the next year. So likewise, your bonuses are getting accumulated over the years, and once you reach a certain level, the entire thing is get accumulated, then you can take home. That is also one thing. So it is kind of difficult to have. So then you need to have different weightages for different products and different services. You need to take into account the profitability, weighted factors, what kind of weightages that you are allocating for each and every one, and long-term evaluation of the achieved performance. So when you design a strategic incentive method or a strategic fund, you need to take into account these elements as well. And finally, which is coming from, this is similar to the BCG matrix. It's a kind of a replication of the the very famous BCG matrix, where you have two dimensions. You measure the industry attractiveness on one side, and you measure the business strengths and the competitive position on one hand. So if you are a business which has a high industry attractiveness as well as you have a high competitive position, you may allocate your performance based on ROI, cash flow. The weightages are different. 25% ROI on this, 25% on ROI, 25% on cash flow, 25% on strategic fund, 25% on market share. However, if you are in a high market attractiveness, but your competitive position is low, you may give very high weightages for strategic funds as well as very high weightages for market share growth, because you want to capture the market. So your incentive is to long term in the long run to grow the organization. Again, if you are in a cash cow position, the market is not that really growing, but you have very high market share, then you don't reward for strategic funds and you don't reward for gaining market share, because no point doing so. But you reward people for bringing high ROI as well as maintain a high cash flow. Again, if you are a dog, that means you are in a very weak market as well as your industry market is low. Again, no point of rewarding to grow the market, but you reward them on ROI as well as cash flow. So, in nutshell, this is the evaluation and control element of strategic planning. Is mainly coming from the performance evaluation. Most of the organizations use techniques like budgets, programs and procedures to strategically manage their businesses. And finally, you may ask certain questions. So is that evaluation and control process appropriate for the corporation that emphasize creativity? Are control and creativity compatible? These are the typical questions that you may come across in business. So on one hand, you have to measure the performance, and through controls and the procedures, it may be detrimental to your organizational performance. So likewise, this is a more of an evolving area in business. So there's no perfect answer into this. I recommend you to read this particular chapter in strategic management and business policy. And I also, there are very two interesting books if you could read, if you have enough time. That is, there's a book called Balance Scorecard, which is written by Professor Kaplan, who is the inventor of this particular methodology of Balance Scorecard. And there's a book called Strategy Maps, which is the second version of Balance Scorecard. I recommend you to read these two books. These are very, very good readings that is there for strategic management in business, Balance Scorecard as well as Strategy Map. And if you have time, read these two books. And also, there's a very interesting read called Blue Ocean Strategy. Again, a book which is the latest, not latest actually, about book is 5 years old now, but it's the latest development in management or in strategic management. There also you have new thinking on evaluation and control, and what to measure and what not to measure, etc. So with that, I would like to conclude this lecture. And if you have any questions, you may raise now. So we have about 15 minutes. Please raise questions if you have. You may come online, or I should be able to answer. Are there any questions? Any things to clarify? Any questions? Okay, so since there are no questions, let me wind up this particular session, and thank you very much for your participation. And I would recommend you to read chapter 11 of your study text, as well as those two books that I mentioned to you, the Balance Scorecard as well as Strategy Map. Those are very excellent reading in this particular section. And thank you very much, and have a good day.